Greetings, friends. We're going to talk a little today about evidence and documentation within the audit context. Okay, excuse me. So this is a flowchart of the cycle which describes the relationship of audit evidence to the audit report. It flows just like you see in the picture. Or in the slide I should say, there are financial statements about which management makes assertions. Those assertions are tested by audit procedures. Those procedures provide evidence on the fairness of the statements. That evidence allows the auditor to reach a conclusion. The conclusion the conclusion is included in the audit report. The audit report is included with the financial statements. And you can see how that cycle plays out. So there are 6 categories of assertions about classes of transactions and events for a period under audit. They are occurrence, completeness, classification, accuracy, authorization, and cutoff. This type of formatting of a slide should look fairly familiar to you in that I've highlighted in the past that these are the types of things that the CPA exam really likes to test. So these are some of the related assertions about account balances at the end of a period. For example, existence is related to completeness, and rights and obligations related to valuation and allocation. Really though, I included this slide because your book talks about it and it's testable for the CPA, but like many components of the class, I'm not sure how much any of that is really going to help you in doing an audit. Okay, similar to the last slide, but now we're talking about assertions having to do with presentation and disclosure. There are accuracy and valuation, classification, understandability, occurrence, and rights and obligations, and completeness. It's just a copy of Table 5.2 from the textbook, more just included for reference purposes. But it provides a summary of the potential categories of management assertions. This is just the textbook definition of audit evidence. Take it for what it is. So there are 3 main important concepts related to audit evidence. We'll talk about each of them in more detail in the next 3 slides. But they are the nature of audit evidence, sufficiency and appropriateness of audit evidence, and evaluation of evidence. So you may never be asked anywhere really to cite all of these, but you should have at least a vague idea of some of these that you could call up from memory for various components of the CPA exam. So these are just examples of the nature of audit evidence. So some of the things that will be looked at in gathering audit evidence. So this slide pretty well explains itself. Sufficiency is the measure of the quantity of audit evidence. The greater the risk of misstatement, the greater the required quantity of audit evidence. Higher quality audit evidence results in a lower quantity of audit evidence. That's in my opinion, pretty self-explanatory, pretty obvious statement. So this is just a nice little conceptual flow chart for appropriateness. Appropriateness is a measure of the quality of audit evidence, which is determined by its relevance, the audit evidence's relevance and reliability. When looking at reliability, some of the components that you want to look at are: is it coming from an independent source outside the entity? Is it effective as an internal control? What direct personal knowledge does the auditor have of whatever you're looking at? And then obviously original documents and documentary evidence. kind of explain themselves. In this flowchart for evaluation, I would pay special attention to this box down here and these highlighted in red words. Auditors should be thorough in searching for evidence and unbiased in its evaluation. These, for whatever reason, I guess just because of the nature of the exam and the nature of the content for the auditing portion, buzzwords like this are very testable and very often tested. So audit procedures, textbook definition, defined as specific acts performed by the auditor to gather evidence about whether specific assertions are being met. So within that umbrella, you've got these three categories of procedures: risk assessment procedures, tests of controls, and substantive procedures. The terminology in audit program is basically a compartmentalized set of test assertions for a specific component of a financial statement. For instance, could look at accounts receivable, and in that you may test for existence of the accounts receivable by sending out what are called confirmations, which are just letters to various people that you say owe you money. You can test the rights and obligations assertion by inquiring of management whether or not the receivables have been sold, or just figuring that out. You can test completeness assertion by agreeing the total of the accounts receivable ledger to the accounts receivable control account. So basically just looking at the individual accounts receivable and balancing that out to the overall accounts receivable. And you can test evaluation by testing the adequacy of the allowance for doubtful accounts. So basically comparing historically estimations on allowance for doubtful accounts and reality, and just seeing how that's played out. So vouching is the process of checking a journal or ledger to the source documentation that backs it to test for the occurrence assertion. Tracing is checking source documents to a ledger or journal, so just comparing and from the other side, basically. So coming from the journal to the source documents, that's vouching. From the source documents to the journal or ledger, that's tracing. Again, in the context of real life, who the hell cares what you call it? If you are examining whether it happened or not, starting from either side, the vocabulary is not going to help you terribly in your life, other than if it's being used and your boss says, hey, go trace this or vouch this, depending on the stuffiness and the laid backness of the culture in your firm, that may or may not happen. But for the most part, not actually going to help you do the work. Inspection of a tangible asset means to physically examine the asset. So pick it up, look at it, go find it in the garage, whatever the case may be. Observation is the process of watching a process or procedure being performed by others. Pretty self-explanatory there. No different than the word in normal English usage. When conducting inquiry, these are the things that the auditor should do. This is basically just asking people questions. Again, we're just formalizing what we call that to make it more difficult, I guess. Yeah. Confirmation in the textbook is defined as the process of obtaining a representation of information or of an existing condition directly from a third party. This basically means if the company you're auditing is saying something about an outside party, go check and see if it's correct. Okay, so that was my neighbor's dog barking. Hopefully you can't hear that too badly, but I will continue here. Okay, this is just a kind of summary of various places you would look for confirmation of these items. A couple definitions for you there. I don't really need to explain those any more than what you see. And again, some more definitions. You can see why I feel like maybe there's not a whole lot you're going to get out of seeing me face to face and reading these definitions to you. But I could be wrong. Anyway, yeah, just some definitions to take a look at. Generally, as you go up and down the level of independence, so the further removed or the less of an interest that the confirming party has in the company that's being audited, the more likely that the information they're giving you is accurate, or at least that it's not tainted by the bias of the underlying company. This is a recreation or a depiction of figure 5.3 from the text, just a flow chart of the audit testing hierarchy. It's just one way, an analogy, a way of looking at the required assurance for various types of assurance engagements, including audits. But basically a way of saying, hey, if you get to the top of this bucket, that's the amount of assurance that we need. So we don't really care for, I don't want to say we don't care how we get there, but we don't care if there's a little less test of controls if that amount of assurance is made up in one of these other components. So if you're cheating or going low in one area to get to the same level of assurance, you're going to have to add it somewhere else, is basically what this is telling you. So depending on the various scenarios and the various details, obviously this is going to be very ad hoc, but each different assurance bucket for each assertion can be filled in different ways and can be made up of different levels of the various components. These are the three functions of audit documentation down here, and just the textbook definition of what audit documentation is. These are the common way that you'll hear this talked about is working papers. Important, obviously, mainly from a cover your ass perspective as an auditor, just to make sure that you've crossed all T's and dotted all I's if in the future some issue comes up with the audit. This is just a broad guideline of what should be included in the audit documentation. And some more stuff. And some more stuff. And some more stuff. You can see that audit documentation is a big deal. I think I've adequately expressed in the past the kind of agency issue that exists for auditors where they want to do a good job, but at the same time they want to get hired back. So they may be inclined to have the audit seem more favorable than it should be, just so they get hired back. So with all these competing different concerns, very important to make sure that the documentation is very thorough. This is an area that, it's very easy, especially if you're an auditor who has never had a lawsuit, very easy to skimp on the documentation. Obviously, when you're talking about public accounting firms, they're sophisticated enough and have enough money flowing around and have their own legal departments and all of these other fail-safes that are going to kind of guarantee that they have good documentation. But at the lower levels or the smaller firm levels, I think that's where there's really a need to ensure that the documentation is sufficient. Something to note here, tick marks. Why is that important? I hesitate to say that that's entirely necessary in the digital world that we live in, but this is just an example of, making the format of it is important for a number of reasons. A, to make it usable to yourself, but B, if you're ever coming back to it and having to use it to defend yourself in court or wherever, if you don't have it set up in a usable way, then it's a lot easier to say as someone who's trying to sue you, hey, this was an afterthought. They didn't actually do this as they were going. This was not part of the process. So the tick marks are just something that they might look for to show that you actually, not only did you document at some point, maybe even after the fact, but you actually, as you were going through, you had a plan, you documented as you were going, tick marks, check marks, just indications that you were working through with the documentation as you were working through the audit. So how long do you keep the documentation? Obviously, if this is a sizable amount of physical paperwork, you don't want to keep that stuff around forever. This is kind of a difficult one to answer with a guaranteed amount of time. Under SOX, there are specific amounts of time that you have to keep documentation, and it varies based on the size of the company. But if you're not under the umbrella of a publicly traded company where you have to comply with a lot of the components of Sarbanes-Oxley, then it becomes a lot more of a judgment call. But like I said, a large component of the audit documentation is to protect you. So, the smartest thing to say is, well, as long as you could potentially be sued in a manner in which that audit documentation would be necessary to defend yourself, that's how long you should keep it for, as a minimum. So there are three general purposes for analytical procedures. They're used to assist the auditor to better understand the business. They're used to obtain evidential matter or evidence about some of the assertions about account balances or transactions. And they're used as an overall review of the financial information of the overall entity in the final review stages of the audit. These are, of course, not all-inclusive, or I should say this is not an all-inclusive list of the analyses possible during the analytical procedures portion of the audit. But we've talked about some of these a little bit in the past. Trend analysis would be, looking at, okay, over time, how has this played out, comparing this year, last year, that type of thing. You can obviously do that at various levels of the audit. Ratio analysis, that's pretty self-explanatory, but analyzing things based on financial statement ratios, and just the sniff test. Is it reasonable? This is just a recreation of Figure 5.7 from the text. It's an overview of the decision process for an auditor for substantive analytical procedures. So for a more detailed look, the first step in using analytical procedures is to develop an expectation. Auditing standards require the auditor to have an expectation whenever analytical procedures are used. An expectation can be developed using a variety of different information sources, such as those listed. This is the next step in the using of analytical procedures, and that is to define a tolerable difference. Finally, we compare and investigate. Compare the expectation to the recorded amount, and if there's any difference, you look to see if the difference is, well, you dig deeper for anything that's greater than the tolerable difference that you've already set out. If there are differences between expectation and reality, using analytical procedures during the risk assessment process, you don't have to find any corroborating evidence. But when you're in the final analytical procedure phase of the audit, if those same types of differences rear their heads, then you need to seek out some corroborating evidence to ensure that you are seeing something that is correct. These are just some important short-term liquidity ratios. You've probably seen these in your finance class. Again, these are various financial ratios. I won't get into them much, more finance topics, but auditors use these as well, especially in analyzing the reasonableness of what they're looking at. Same with these ratios, and that's the end of the chapter. All right, so that's all I have for Chapter 5. Again, we'll have some personal instruction time available during regularly scheduled class time, where I'll be in my office, but the time will be dedicated to students for this class. So if you need to talk to me or have any questions about anything we've gone over, just let me know. I will be there.